Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, Ava Benesocky, and I'm joined by my co-host, August Binjaz. We have another great show for you today. Please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and expert guest speakers. Our mission is to empower investors to earn passive income through real estate investing. We're really excited because today we're joined by Elliot Milek, and he is an experienced tax specialist with a strong focus on Canada, US cross-border tax accounting. So we believe this interview with Elliot will bring great value to both active and passive investors looking to learn how Canada, US cross-border taxes work. Welcome, Elliot.
Well, thanks for the introduction, guys. I appreciate it.
Yeah, we're really looking forward to this. Is like my favorite topic, so cross-border accounting. So let's dive right into it. Maybe
very good.
Yeah, it's your favorite topic because you get grilled by investors investing in the U.S.
Yeah, totally. Elliot, we would love to just start off with you telling us about your background and what was it about cross-border tax that interested you in this field of accounting?
Very, very good. Yeah. So to give you a bit of a background on myself, I was born and raised in Ottawa. I'm currently in Florida at the moment, but sort of enjoying the nice weather these days. But I've always been interested in finance and tax. So kind of when I started out my journey, I was always reading the kind of the Rich Dad books. Back in high school, back in elementary school, even in college. So I was trying to figure out kind of the path I wanted to take. I always knew it would be some type of business focus, whether it's finance, whether it's insurance, whether it's or tax or accounting, essentially. So I sort of decided to go through the accounting field. So I graduated from the tax business there at Carleton University. Got about 15 years ago now. After I graduated from Carleton, I worked at a couple of the larger firms, both at Ernst & Young and Deloitte, and then I worked in a private company essentially for a couple of years before kind of branching out on my own. When I first started out my journey, I wasn't too sure whether I was going to be working on the Canadian side or the US side, fresh out of university, I was kind of willing to take any job that was kind of offered to me. So a friend of mine at Ernst & Young, he decided there was an opening in his US tax practice there. So they brought me in for an interview. And of course, I was very energetic to take anything I offered. So I got introduced into the U.S. tax practice there. I bounced around, in various departments there, but ultimately I decided that, due to the complexity and due to the constant changes that happen a lot more frequently on the U.S. side, I decided to focus my attention more on the U.S. tax practice at Ernst & Young. So I worked there for about 8 years. I went to Deloitte for a couple of years as a manager there, and then I worked for a construction company in Ottawa, in their tax division essentially. They had a lot of projects in the United States and Europe, so I did a lot of international tax there. About 4 or 5 years ago, I kind of branched out on my own full time. I was always interested in real estate focus. I own some rental properties going back 10 years ago. I've been buying in New York. I've been buying in various states in the US. So I always knew I'd kind of build my practice around real estate focused, cross-border issues essentially. So I work, about 60% of my practice now is Canadians that are buying US property. I have a lot of Canadians that buy exclusively just Canadian property as well, but we work with a lot of Canadian businesses that sell to the US, a lot of US citizens that live here in Canada. So we're, I would say 98% of our business is some type of cross-border component. It's rare that we only have, clients that just have an exclusively Canadian component essentially to their business. So.
Incredible, great background. Thank you for that. Okay, let's dive right in. What is double taxation and how does this happen?
So double taxation typically occurs when you can't take some type of credit on the opposite side of the border. So for example, if you buy a property in the United States through a corporation, you're paying corporate tax. When you take the money out as a Canadian, you pay tax individually as well. So you're paying tax twice on that same income, right? So there are certain vehicles where we can structure you to kind of avoid that double taxation situation. Typically I guess we'll dive into the details on different various structures, but typically, when you're not getting some type of credit in Canada, that's typically where double taxation arises. So.
Got it. And this is a corporation. So if a property is purchased in a corporation, then Revenue Canada doesn't see that any profits you've made, you pay your taxes on the corporate level in the US, but when those funds are repatriated, Canada doesn't account for that taxes you've paid on those capital gains to the US, and then taxes you on the total sum again, the original sum, or the only sum that you brought over?
It's the after amount. So say, for example, you make $100 to a US corporation. In the United States, you're going to pay 21% federal tax. There might be some state tax depending on where the project or the property is located, but you'll pay 21% tax. Since you're a Canadian that owns that US corporation, there's as long as a 5% withholding done on that dividend essentially to you. So that's 5% you won't get back because it's not subject to a foreign tax credit here in Canada. And essentially on that $100, you're already down $26 on that profit. So then you pay additional tax on that $74 remaining in Canada based on your marginal tax rate in Canada. So if you make over $200,000, you're in a 50% tax bracket already in Canada. So you're going to pay about $35 on that $74 remaining essentially. So your after-tax amount is what, 35, maybe $40 at most on $100 of earnings essentially. So you're paying about 60% in tax on that income, which is certainly not a tax efficient way of doing business.
Yes, and most, not most, all of our investors are accredited. So in most cases, they're making more than that 200K amount a year, and they've made it in the last few years. And so if they they go the route of investing through a corporation in the US or into it, does it make a difference if it's a corporation or if it's an LLC?
So good question. So LLCs are taxed differently on the US side as opposed to here in Canada. So LLCs typically for most US investors and US individuals living in the United States, they're considered what's known as a flow-through entity. So all the income flows up directly to their 1040, their individual return, and they pay tax based on their individual rates. In Canada, if a Canadian owned an LLC, CRA taxes them as a corporation essentially, right? So because it's not actually owning the property directly in your personal name, there's no kind of partnership type structure with an LLC. CRA deems that LLC to be a foreign corporation, which is subject to that double taxation that we just spoke of. Yeah.
Great.
All right. So as we kind of move along through our discussion today, we're going to have two main focuses. First, for Canadians looking to acquire investment and vacation homes in the US and the correct tax structure for this. And then secondly, Canadians investing passively into US syndications, or as we call it, real estate private equity investments, and avoiding the costly double taxation pitfalls.
Great.
Yeah. So let's go ahead here.
Okay, perfect.
Yes.
So let's discuss Canadians buying investment or vacation homes in the US, leaving out like the US debt and financing concerns. But what is the best way for a Canadian to purchase US real estate?
So I think a lot of it's going to be dependent on where the funds are coming from, right? And that's going to be key for the individual. So, when you're buying a vacation property, a lot of these individuals may have, holding companies in Canada because they have businesses in Canada, right? And that's typically where they store their cash. In that case, a lot of times, if you're buying a vacation property, it may make sense to buy through that Canadian holdco. And the main reason for that is because you don't have to take the funds out of Canada or out of the company, I should say, and pay personal tax on that income. So, Canadian companies are allowed to buy property in the United States. The rental income will be reported on the US side. So that Canadian company will have to file a US tax return. But typically for vacation properties, after you take depreciation and all that good stuff, there's really very little profit to earn or to report. So it's really just a filing obligation that needs to be done on the US side, right? If you are buying a property, typically if you have personal funds, and then that's where you're going to be buying the property, a lot of people do buy it through their personal name. Again, there's liability risk that you want to be concerned of. That can be mitigated with proper insurance. The other issue is also financing. Again, you said you don't want to talk about financing, but a lot of Canadian banks will lend to Canadians in their personal name. But if you're going through the US route and you want to get a US lender, you might have to set up some type of entity in the US to buy that vacation property, right? In both instances, you will have to basically apportion the amount of expenses that are solely used for rental purposes, right? Because the IRS and CRA will not allow you to claim deductions that you're using for your personal use. So you have to kind of figure out the amount of days you spent in that property and how many days were rented out for the year, and apportion the amount of days you rented it out, and can only claim a portion of those expenses on your tax returns, essentially. So yeah, so those are kind of your two options. I mean, you can set up, a lot of people like to set up a partnership typically to buy vacation properties, but for most people, typically the incorporation costs and the additional tax fees typically don't outweigh the benefit of doing that.
Right.
You typically want to set up an entity when you plan on buying multiple units, where kind of the cash flow can kind of outweigh essentially the incorporation costs and the additional fees you're going to be paying on a yearly basis. So.
Quick question on that. That's a Canadian partnership to create, or a US partnership they create to buy it through that, if that's the route they want to go?
Yeah, so to be honest, it could be either. I would speak to the bank, because most Canadian banks won't lend to a US partnership. So you might have to get a Canadian partnership. If you're getting a US bank, then they're not going to lend to a Canadian partnership. So you'll have to get a US partnership. Typically, if you are going the US route, I typically prefer a US partnership. And the main reason is because you don't have to file the additional Canadian tax forms every year, which kind of saves on the compliance costs every year. But
you buy a vacation property through a U.S. partnership.
Yeah.
At that time, so the U.S. partnership owns your vacation property. Now, if you got it, so then every year you don't have to file Canadian taxes for that U.S.
For the partnership.
Well, because you don't have any income, right? Because it's a vacation.
Well, if it's just solely for a vacation purposes, the way it would work through a company or a partnership is that the IRS considers you using that for personal use. So you have to kind of deem rent on the personal use through a company, right? So if you use it for 100 days out of the year personally, and you don't rent it out, then you have to deem the fair market rent and recapture that rent on your partnership return or corporation, however you choose. Okay, you can claim the expenses for those 100 days as well, but the remaining portion can't be claimed. So, if you use it personally 100 days and rent it out for 50, basically you have to report the 50 days you earned from a third party and 100 days that you own personally, essentially. So it's kind of there's kind of that happy medium you need to figure out, but this is why typically most people kind of buy their vacation property in their personal name, because it's a lot simpler, essentially. Nice way of saying it. So.
For sure. Now that kind of leads me to my next question for Canadian buying an investment property in the US for cash flow and appreciation, right? How can the cash flow be repatriated to Canada every month? And then of course, when the property is sold, how can the capital gains be repatriated in the most tax efficient way?
So typically it's going to be dependent on how the investment's made. So are we talking about like a syndication type project, or are they just buying property themselves? Okay.
An investment
Just
property.
and we're going to get into the syndication stuff shortly here.
Yeah, just curious.
So if you have an individual that's buying property, they can buy property in their personal name. The rental income, they'll have to file a U.S. tax return if they do it individually to report the rental income. So essentially, the way it works, by buying property on the U.S. side is that since the property is physically located in the United States, the IRS in that state jurisdiction gets first crack at that tax, right? So say, for example, you buy the property in your personal name, you have to file a US tax return individually, file a state return, and pay tax there. As a Canadian, you get taxed on your worldwide income, right? So you have to report that US source income on your Canadian individual return as well. But because the property is owned in your personal name, you get what's known as a foreign tax credit here in Canada, right? So that offsets that double taxation situation, because if we use an example, you buy your personal name, you make $100 of profit on the US side, you pay $10 of tax in the United States. Say, for example, you're in a 30% marginal tax bracket in Canada, you pay 30%, but you already paid 10% to the United States. So you have to pay an additional 20% to CRA, right? So you kind of pay that top up there. So typically, when people are first starting out, they buy in their personal name because they don't have to incur the corporation costs, the tax fees, and you do get the ability to use the foreign tax credit, which is, again, the most efficient way to repatriate funds back to Canada, right? Again, a lot of people use Canadian holdcos, which is, again, that's where the majority of your funds are, and you don't want to take the funds out of the company to pay personal tax on it. Again, you can use that Canadian holdco to buy a rental property. That rental property, again, is going to be subject to a U.S. tax return, and same things. You have to file a U.S. tax return on the U.S. side. The Canadian company will be eligible for a foreign tax credit, which offsets that double taxation situation. there is a C corp, which I typically, again, like I said, I typically try to avoid because it does result in double taxation. But again, and typically the most prominent way and where most people typically invest in U.S. property is through some type of partnership in the U.S. And the main reason for that is because it is considered a flow-through entity. So an limited partnership is considered a flow-through entity for both CRA and IRS tax purposes. So you do avoid double taxation there. And then you do get the benefit of a foreign tax credit on the Canadian side. So you're not kind of double taxed on that rental income and also on the capital gains if you sell the property. So.
Okay, great. All right.
Nice.
So let's switch the conversation and discuss, syndications or real estate private equity investments. In recent years, with the growth of groups such as Cardone Capital, U.S. multifamily investments have become mainstream. More and more people want to invest in U.S. multifamily passively as limited partners. This has increased Canadian investors also looking to take advantage of tremendous gains available in the U.S. Some U.S. multifamily firms accept Canadian investors, but most investments are structured in LLCs. And earlier on, you explained what the issue is with a LLC structured entity. Revenue Canada sees that as corporate income, and then you pay taxes on the U.S. side, but then you also have to pay taxes on the Canadian side. Now, the question is this. So if a Canadian investor invests with a U.S. entity, a U.S. syndication outfit or a real estate private equity firm, so they make an investment, they receive their cash flow, and when the property is sold, they receive their initial investment and capital gains. Are they subject to taxes on the U.S. side because they invested in this LLC?
Yeah, so if we go back to where the actual project is located, that's the jurisdiction that gets taxed first, right? So if you invest into a U.S. LLC that owns an asset through a syndication, the tax is going to be paid on the U.S. side first, and then as a Canadian, you get taxed on your worldwide income on what's remaining, essentially. So if you are investing into a U.S. syndication, as you alluded to, LLCs are not the most tax-friendly way for Canadians to do so. But we can certainly dig into the details later. But at the end of the day, I mean, typically, the Canadian individual will have to file a U.S. tax return to report the U.S. source income, pay the U.S. tax. Then that whatever's remaining will have to be reported on the Canadian side, whether it's through their individual return if they made the investment directly in their personal name, or through the Canadian holdco if they have a Canadian company that made the investment. So.
Got it. So Canadian holdco or personally invests into this U.S. LLC as a syndicated investment. The U.S. LLC then pays the investor. Does the U.S. LLC is required to do any withholding tax, or do they hold any taxes back, or does the Canadian investor has to file U.S. taxes and pay their portion of U.S. taxes at that time?
Yeah, so typically an LLC on a distribution or a profit or a capital gain is required to withhold a certain amount. So typically it's about 37% for an individual. That's the highest tax rate on the individual side, or 21% as that's the corporate rate if it's a Canadian company. So anytime an LLC makes a distribution, they have to withhold that amount and issue it and send those amounts to the IRS as a withholding on behalf of that foreign investor. Okay. So the main reason, so it's not really a tax, it's more of a deposit that's made with the IRS. So it forces that individual, that Canadian individual or Canadian company, to file a tax return to report their actual or to report the actual amount of tax that's required to be paid, right? And the actual amount of tax less the actual withholding that was done remitted to the IRS is put together, and then the difference is essentially refunded to the individual, right? So 99 times out of 100, you're going to see, there's going to be a refund because the withholding is typically larger than the actual, tax that needs to be paid. So it forces that Canadian individual or corporation to actually file a tax return, and that's why they do that. So there's obviously issues with respect to, when the projects are sold, because typically you don't get that refund back until the next filing season. And even then, after you file a tax return, in April or May or June, it takes 3 to 6 months to get a refund back. So So there's certainly a time lag with these projects, for us Canadians. So it is something we need to plan kind of ahead of time before you kind of sell a project essentially. So
great. Now let's discuss this a bit farther. So now the LLC pays the investor their distributions and their gains. There's withholding tax done. The remainder of the funds are brought back to Canada. Now, the Canadian investor has to file their U.S. taxes to figure out what is the total amount they owe. They do those filings. They're forced to do those filings. But because the source of the funds was from an LLC, does this also trigger the double taxation here, even if they file U.S. taxes?
it does, because, say for example, they're making the investment in the personal name to this LLC, the tax is done at the, essentially through a corporation from CRA's eyes, right? So, that tax you paid on the US side is not eligible for a foreign tax credit in Canada, right? And that's kind of where the double taxation leads to. So, again, if you go back to our $100 example, if the LLC makes $100, you pay $10 to the IRS, the remaining $90 is subject to tax in Canada, essentially. So, you don't get that $10 credit back, essentially. So, but typically, and the main reason why CRA has this LLC, foreign corporation type rule is because they take the position that the characteristic of an LLC, because it's a separate entity, and there's actually no general partner in this type of structure. It has a characteristic more of a corporation that does an actual flow through partnership, essentially like a limited partnership. So that's kind of where a lot of Canadians kind of run into, because they typically deal with a lot of US accountants, a lot of US lawyers. And
a lot of U.S. operators, and that's my next point I want to hear, because we're in this space. We're creating a lot of content. We've become thought leaders when it comes to Canadians looking to invest in U.S. real estate private equity investments. And what we've noticed is that some U.S. Operators, syndications, do offer their investments to Canadian investors. But what they require now, they structure the deal in a LLC, but what they require from the Canadian investor is to form a U.S. entity and invest through that U.S. entity. And also there's a misconception and misinformation that exists out there that if the investor goes to the U.S., doesn't have to go there, but in the U.S. creates a limited partnership, and limited partnership are flow through entity, and they're tax efficient and they're a great structure to use. But if they make their investment through a limited partnership into a LLC where the sources of their gains are coming from, somehow this middle feeder fund limited partnership will relieve them from double taxation because there is a limited partnership involved. Please explain this and correct me if I'm wrong, if this is a misinformation, if it's incorrect or not, or if this is a great way to utilize for a tax structure.
Yeah, so it's certainly a gray area, right? And the issue there is that CRA hasn't really come out and provide a lot of clarity on this, essentially, right? So I even see some Canadian CPAs and lawyers take the position that if you have that USLP as a blocker underneath, then you can't really see the LLC underneath. So typically, when you go through a CRA audit, they'll look at the actual source, which is the USK1, which is coming from the limited partnership. But a lot of CRA agents may not ask where, if there's anything underneath that structure, essentially. So the good ones will, and that's kind of where the issue lies. Is that since the U.S. source income is coming from essentially a foreign corporation from CRA's purposes or an LLC, a lot of CRA agents will take the position that it's a foreign corporation with a USLP on top, with a Canadian resident owning, essentially. So now we kind of have the issue with the double taxation situation that we alluded to. So typically I try to avoid these types of situations by owning the asset directly through the USLP. Again, this is not something you'll get a lot from the US accountants and US CPAs, because they're just not aware of how CRA regards LLCs from Canadian perspective. So
really
okay. And the other concern is you have a U.S. operator. They're very focused on raising the equity needed for their deal. They're open to allow international investors to invest. Their accountant has said, hey, as long as this Canadian investor invests through a U.S. entity, they're good. And LPs are a great entity to use. That's the instructions they give to the Canadian investor. Canadian investor goes and creates a U.S. limited partnership, invests to the investment through their U.S. limited partnership. but then, this could be problematic. It doesn't solve the issue.
Yeah, and then my next question for you is, because they've created this, entity in the U.S., they have to file taxes for that entity in the U.S. as well. So that's an extra cost as well for an investor, correct?
Absolutely, and it really doesn't doesn't disregard the whole issue, foreign corporation issue, right? So there's additional compliance fees, additional corporation fees you need to consider. So, and at the end of the day, I wish there was 100% clarity on this, but Syria really hasn't come out and provided that to us yet. But so, again, the best way to mitigate that is really to eliminate the whole LLC formation as a Canadian. That is earning passive income, and that's key, right? That you're generating rental profits, which is considered passive income, which is subject to the what's known as the FAPI rules here in Canada. And that's kind of the issue a lot of Canadians face. So if you can set up that USLP, and if you have a US syndicator that's willing to use a limited partnership type structure as opposed to an LLC, then if the returns make sense, then that's the route you should take. So
great. Awesome.
All right. Now, another concern for an investor is the U.S. operator will provide the Schedule K-1 to each investor at tax season. But the Canadian government does not recognize a K-1 and needs the K-1 to be converted to a T5013 slip, which is the Canadian equivalent. Maybe you can talk to us about the conversion, and as a Canadian accountant, what information do you need from the U.S. operator to complete the transfer? Does having a K-1 suffice?
Yeah, so typically when you're buying, if you're buying kind of yourself and you have your own kind of USLP yourself, where you're the 99% owner, typically the correct way the CRA wants to show that rental properties through the USLP is on Form T776. So even though you technically receive the K1, you should be reporting, say, that your proportionate share of the K1 income on Form T776, which reports, the actual rental income from the properties and all the expenses associated with that. If you are investing into like a syndication type deal, typically you're not having a large portion of that partnership. You might have 0.5%, 1%, 2%, whatever the case may be of that project. So certainly it's a little bit more difficult to obtain those numbers. But ideally that's the correct approach that I typically take with my clients. But a lot of people will just kind of, convert that to a T5013, which is a Canadian tax slip, to report the partnership income and report it as essentially as foreign investment income on the Canadian side. It's typically more simplistic. It's not always the correct approach that CRA likes to see, because they actually like to see the amount of profits and the rental income that's earned from the actual U.S. investments. So.
Got it.
All right, now. Okay, multifamily investments are one of the most advantageous passive investment options for busy professionals because of all the tax benefits they provide. It's super exciting, such as depreciation, cost segregation, bonus depreciation. Could you please explain these tax benefits? And let's be clear, everybody, we're talking about U.S. investors investing into a U.S. syndication. Okay,
so the U.S. investors, yes. I mean, if you're a U.S. individual investing into the United States, you are allowed, proportionate share of the depreciation and on all that good stuff, essentially. So, as a syndication type deal, for most of these individuals, they're not active real estate investors. They're typically, they typically have a W-2 income. They may have their own job. So, typically they're not allowed to be eligible for these active real estate rules in the US, but they are eligible to claim the depreciation, depending on the partnership agreement. So in the US, there is kind of accelerated depreciation where typically, appliances, vehicles, furniture would have to be depreciated over 5 to 7 years or whatever the case may be. But over the past, 10 to 15 years, there's been a lot of these accelerated depreciation rules where, if the recovery rate is under 15 years, essentially for an asset, you can claim the full expense in the year of acquisition, which is, certainly a nice benefit because, you can capture losses with the first couple of years that you bought the property and carry those losses to the future. So if it's structured properly, there's a lot, first 4 or 5 years of any type of syndication deal, you really shouldn't be reporting a taxable income for the investor, and essentially you don't have to worry about paying tax on that investment until 4 or 5 years once those losses have been recovered. So
yeah, and the cool thing is you can roll them over, right? You can roll them over, and then on the back end, when you have the capital gains, you can have a big paper loss, right?
Yeah,
exactly. That's incredible. Did you want to do an example?
We'll do an example after we can compare the Canadian.
Okay, yeah,
for
let's
a
do that.
Canadian compared to the U.S. investor after you ask the next question.
Yeah,
That would be
because
great.
yeah, absolutely. We know we obviously know like there's incredible tax benefits for U.S. investors, which is great. But how about a Canadian investor? Can they also benefit from these tax benefits? And if not, what are the tax benefits for Canadian passive investors?
Yeah, so typically when you're investing as a Canadian to a US syndication deal, you have to report that income based on CRA rules, right? So you report that income on your form T776 or as a foreign investment, however you choose. But typically, you can still claim depreciation, but unfortunately, Canada just doesn't have those accelerated depreciation type rules like they do in the US. So technically, you're supposed to report it on form T776 and use the depreciation rates of that CRA has imposed on us, essentially. So we can create a bit of a mismatch, between the two countries. And like we talked about, how you can carry over losses on the U.S. side. In Canada, you can't claim a loss on real estate investments using depreciation or CCA, right? So basically,
Canadians cannot report losses of depreciation on foreign investments?
On foreign, correct, yeah. So basically, it has to be done based on CRA rules, right?
On the Canadian rules.
Got it.
Which, Elliot, to my understanding, and maybe you can, we can talk about this. Is it 4% per year that you can claim as depreciation on
a property's initial purchase price kind of concept? And does that 4% get, like if we buy a $10 million property and we have a limited partner who's invested a small percentage, do they get to utilize pari passu to that 4% of the 10? Explain that. How does that work?
Tax laws, yeah.
Yeah. So if you buy a property through USLP, yes, you're correct. I mean, the residential rate in Canada is about 4% on a building or residential property, right? Every time you take that 4%, the following year that essentially that asset base gets reduced and your depreciation rate gets reduced as well on a yearly basis. So, in the US, residential property is a straight line depreciation over 27.5 years. So the depreciation rate is going to remain constant for that building essentially throughout the life or until you sell it, right?
Right.
So that's why typically, you have a little more clarity on the US side, but as a Canadian, you have to use the CRA rates of 4% per year, based on, that's what essentially the CCDA rate for that building is on Canadian tax rules. So
Canadian tax rules. Now, taking that 4%, you can roll it over, right? You can roll it over every single year and then utilize it on the capital gains on the back end. And then another question I have for you, can you take that loss and use it against your ordinary income?
So if you're not claiming depreciation in Canada on that asset, then yes, you can certainly use that loss for that property against your ordinary income, right? But you cannot claim CCA to claim a loss on that property to be used against your T4 income, essentially. So your CCA can be reduced down to zero for that, for that property, and then there's no loss to report, there's no income to report. But if you have a number of expenses that exceed your rental income for that year, maybe you had a significant of repairs or whatever the case may be.
Yeah, right there, that one. Tell us.
Yeah. So if you actually have repairs as opposed to capital expenditures, that maybe, I don't know, maybe you had a 20-unit building and every single unit needed repairs that there were significant in value that exceeded that rental income for the year, and actually reported a loss. You cannot, in Canada, you can't claim CCA, but you can claim that loss against your T4 income if you have it, or business income, however you choose.
Okay, cool. Great.
All right, very cool. Learning lots today, learning a lot. Now, okay, next question. Let's discuss cash flow distributions. So assets we acquire in the US are cash flowing from day one, unlike most investments available in Canada. We send out monthly distributions to our investors. Can you please explain what is return of capital and why don't investors have to pay tax for the term of the project while receiving cash flow, which is return of capital?
Yeah, so typically the investments that most people make or most companies make are with after-tax cash, right? So you go to your job, you make $100,000, pay $30,000 net tax, and you have $70,000 left. You take $50,000 of that, you already pay tax on that $50,000, right? So you make an investment, it's already using after-tax cash. So when you make that investment, you get those funds back tax-free essentially, because you already paid tax to CRA on that income, right? So your first $50,000 of distributions you receive is tax-free. Anything above that is typically a capital gains, or depending on how the project's structured, but it's typically capital gains above that amount. So.
Okay.
Got it.
Okay. Very
Got
cool.
it.
Perfect. Thank you.
And
for
capital gains, the way it works here in Canada is you're taxed on 50% of the capital gains, and the remaining 50% gets added to your income. And then that total amount is taxed not at the bracket that it aligns with then.
Exactly. Yeah, you're exactly right. So if you make $100,000 capital gains, only 50,000 of that is included into your income individually. And if you're in a 30% tax bracket, you pay 30% tax on that 50,000. So you're not taxed on the full amount like you are in the US, but we do have higher tax rates here in Canada. So, but essentially, a nice way of saying, typically when you can get capital gains as opposed to ordinary income, in most cases, it's most beneficial for you, either as a Canadian or the US individual. So.
Amazing.
All
I
right.
really appreciate that. It's like the last 2 years we've spent our lives learning about taxes, and we still learn something new every time we talk to an expert. Really appreciate that. Okay, great. That concludes this segment of our show. Thank you so much for all the incredible information we kept.
Incredible.
We hope that anybody who's watching this get in touch with Elliot, because he's the master of cross-border taxations. But go ahead, Ava, let's
start the next segment of our show, Elliot. We're really excited about this.
Absolutely.
Wonderful. The 10 championship rounds to financial freedom, whatever comes top of mind. Let's have some fun. So first question, who was the most influential person in your life?
Honestly, I would say my father, to be honest. He immigrated from Eastern Europe when he was in his 20s, and he didn't have much college education, but he's always a hard worker, and kind of instilled that in me, right? So I always put in the 12-hour days, and and while we earned our income differently, like I earned my income more as a business owner, and he earned it more as an employee. I certainly attuned my work ethic to him. So yeah.
Incredible.
Amazing.
All right, next question. What is the #1 book you recommend?
If you're first starting out, I would say Rich Dad Poor Dad. It's typically base fundamental, but I've always kind of liked, it was a Think and Grow Rich, was by Napoleon Hill. I've read that a few times over my life, and I honestly always kind of pick up a few new things every time I do read it. So it's it kind of puts me into the brains of some of the best minds in the world, and that's kind of what I like. So
nice one, awesome. Now, if you had the opportunity to travel back in time, what advice would you give your younger self?
I would say don't procrastinate as much as I did. I think I'm more of a planner as opposed to kind of a doer at times, and I tend to kind of over plan at times, rather than just doing the work. And if I want something bad enough, just doing it right away, as opposed to taking weeks or even months or even years to plan things out. So I would just say, it's great to plan, but you got to take action, and that's key. And I wasn't doing enough of that back in the day. So.
And that's why a lot of times great companies are founded by the conservative CPA accountant background with a entrepreneur, and that makes it always a perfect mix.
Exactly.
Absolutely. All right, now what's the best investment you've ever made? Best investment?
People like to say monetary, but at the end of the day, I think it's always your partner who you marry. If they're not on board with what you're trying to do, and if their goals are not in line with yours, then you're really not going to have a very successful marriage and successful business, or even life possibly, right? So I've certainly been very fortunate to find my wife, and she's been right next to me from the start, and when I'm not willing to wake up at 5 a.m., she kind of pushes me out of bed. So she gives a little push when I need it. So
I hope to come to Florida and meet both of you guys.
Absolutely.
Amazing. Now, Elliot, what's the worst investment you've ever made, and what lesson did you learn from it?
Worst investment. I invested, I want to say invested, which ended up being a Ponzi scheme about 10 to 12 years ago in Ottawa. It was actually probably one of the largest kind of rent-to-own type companies down there. So financially, that was probably the worst. And obviously, what I learned from that is I let my emotions get the best of me, essentially. So rather than do my due diligence, rather than speaking to people who've made these investments, I let the returns kind of dictate my actions, and that's, ultimately kind of lost quite a bit of money. And that's kind of what I try to keep in check now, is try to keep my emotions in check and make sure I'm making decisions based on the numbers, as opposed to, based on greed and fear, essentially. So.
And I see that happening with cryptocurrencies and Bitcoin recently. A lot of people feel like they missed the boat. I don't believe they have, but they see these investment possibilities online. They're not sure really about the investment firm. Also get emails from the Securities Commission warning about these investments that are available. So yeah, definitely understand what you're investing in, who you're investing with, and what is the asset class. Great.
Yeah, absolutely. All right, next question. How much would you need in the bank to retire today? What's your number?
So I wouldn't say in the bank. I would say I would need probably between 40 to 50,000 a month in passive income. I know it sounds large, but I mean, at the end of the day, we have 2 kids. They're in private school. After you take off 20,000 a month in taxes, depending on where you live and your housing, and it still leaves you with maybe $5,000 to $10,000 a month of buffer. So for me, my number is kind of the $40,000 to $50,000 passive income range monthly. And that's kind of my number that I can officially maybe take a step back from some of my businesses and reassess on, what I want to do, essentially. So.
Did you hear that, everybody? He said passive income.
Yeah, and that's a very
cool.
sophisticated way of looking at it, because hey, you could have, you could have $5 million or $10 million, but your expenses add up. That money gets eaten away. You got inflation coming on there. You might make some, not very smart investments because you got access to all these funds. But if you have consistent passive income, it allows you to have a certain lifestyle in accordance with that passive income, and then use the rest to either use compounding interest to invest and make other stuff. So
and he knew his answer like that. We are talking to an accountant here. We're talking to an accountant who's good with money. All right, if you could have dinner with someone dead or alive, who would it be?
That's a good question. I don't know. I was probably say my 2 grandfathers, because I never actually met them. They passed away before I was born, but obviously I learned a lot from my parents from them. But certainly it would be nice to meet them firsthand. But so I would probably pick my 2 grandfathers. So
you might need a translator at that.
Probably, yeah. We don't speak the same language, but I guess that's what the parents are for, so to do for us.
Nice, I like that. Okay, if you weren't doing what you're doing today, what would you be doing now?
If you asked me 20 years ago, I would say hopefully hockey player, but
nice.
But, those ambitions kind of died off pretty early when I realized it wasn't very good. So you know what, I don't know, because I always kind of saw myself in this field, even from a young age, to be honest. I always liked business, I always liked taxes, I always liked real estate. I always kind of knew that I'd be running my own business. Did I know exactly what type of business it would be? No, but I just knew I'd be working with people and working on my own, and I have my employees, so to be honest, I really don't know what I would be doing if I wasn't doing this, right?
I love it. That's awesome.
Real estate investor.
Yeah.
All right, Elliot, book smarts or street smarts?
You know what? If you ask me when I was in college, I'd probably say book smarts. But at the end of the day, in business, especially these days, I don't think college education is absolutely necessary to be successful, right? So I do think you need that business acumen, but whether you get an A in a certain class is not gonna make an impact on your life, right? It proves to people that you do have the capacity to sit still and to do the work and get a degree. But at the end of the day, I don't think it defines how you, how successful you are going to be in life. So ideally, if you have the ambition and you're young and you're, in your teens and whatever the case may be, and you can start businesses, I think that street smarts would certainly outweigh the book smarts these days. So.
Very cool.
Great answer.
Last question. If you had $1 million cash and you had to make one investment today, what would it be?
One investment. I would probably just buy a piece of real estate in the Midwest. I think there's a lot more value there these days. So I think you can, for most people, the cash flow should provide you with a pretty nice life, essentially. Assuming you have no other sources of income. So that's probably what I do. I probably just hold it and maybe put into an LP or to a trust that has my kids' names in it, and then kind of just leave it there and let it make me money, essentially. So.
Enjoy the cash flow.
Incredible.
Exactly.
Amazing. Awesome. That was great. That
Awesome.
was great. All right.
Now, Elliot, just really quickly, what's the best way people could reach you?
Best way is typically by email. So you can reach me at Elliot Milek at can-ustax.com, or my phone number is 613-581-2695.
Amazing. And we'll
Awesome.
share that in the show notes
Yes,
as well.
we will.
Hey man, really appreciate you coming on again. You know, you gave us, we've been on a few calls with you. You've educated us, and we've learned some new things also on this recorded call today. So again, really appreciate it. Thank you so much.
Oh, my pleasure, guys. And thanks for having me. And I look forward to the next one. So
I'll have you on again.
thank you.